Without further ado, I'm going to introduce you to our speaker tonight, Gregg Ficery. He is from Integgra, and he's going to talk about valuation and a whole lot more with you. Gregg, take it away.
Okay. Thanks, Mike. Good to be with you all. We got a good crowd online. Maybe the rain might have been a bit of a distraction for some people trying to drive in, but we'll start the party anyway. Feels like a good time for a valuation update. Things are crazy in the market right now. The question, I guess, in a lot of people's minds is how crazy, how much damage has there been, especially on the private market side, which we don't have great visibility into. So especially with the lag in information that's out there. So I do my best to stay on top of these things, and let's give you a little update and overview. I guess it all started, or at least was coming to a head last fall. In particular, I remember being at Venture Atlanta and observing all the companies pitching and noticing that in addition to public markets, private company valuations, the asks were a lot higher than they had been, and especially with very early stage companies. So I was asked by the Atlanta Business Chronicle to write an article about what I had observed, and it ran. It was very well received, and basically the thesis was that private company CEOs and founders should moderate their asks in order to be able to efficiently raise their money and create what I call win-win-win scenarios for themselves, their employees, with their options, and their investors. It just seemed like things were overly frothy or exuberant. So we crossed into the new year, and I was asked to write another article, and I sort of on the outlook for the year ahead, and I wanted to do something a little different. Every article I read at the time seemed to have the same generic points. There were challenges and headwinds out there, the common ones: inflation, supply chain issues, labor shortage, energy prices, policy risks, political, this was even before the war, and valuations were extremely high. So what could go wrong was the theme of the article. Unfortunately, my contact there, Aaron Schilling, who was covering the tech sector, moved on into a new role, and we didn't get to run that. But what I tried to do to add some more value to the typical article at the time was to dig into why, despite all these issues, were valuations still increasing and still too high, at least for me to be comfortable and most people to be comfortable investing. So the one solo point was that there was a excess supply of capital out there. So the dry powder was so available with many of the funds that they were under pressure to deploy the capital, and therefore were desperate to outbid or overbid for many in any deals. And even the smaller mid-sized funds, many of which I work with, were not able to get into deals because they were being overbid by the Sequoias and the XLs and so on. So my attempt to add value came in the form of asking a lot of people smarter than myself, where is it coming from? Why is it so extreme? And what are the risks to it drying up? And the best answers that I got had to do with the pension funds. So this is a little new, not something you read every day. That pension funds, yes, a lot of people that, where they get their money, made a lot of money over the last number of years. The teachers, firemen, collectively, I guess they all grew enough that they supply pension funds with more money. However, the pension funds themselves have no chance, basically, to meet their unfunded liabilities. They've become so desperate to chase yield that they have changed their investment policies to allow themselves to invest more, a greater percentage of their assets into riskier investments. So when they used to invest 1 to 3% of their assets in startups, now they're going 10 to 15%. So they're really putting themselves out there. What could go wrong? But this is where all the money has been coming from. So it goes to the funds, which increase valuations as they deploy the capital. What could stop it? Well, as interest rates rise, they are going to be, have another decision or another equation to consider in terms of how much they're willing to put to risk in that way. Whether that changes and how much it changes their decision making remains to be seen. But obviously, that and whatever has happened since the beginning of the year has changed their and everybody's just decision-making processes, and has started to withdraw capital from the market and in both public and private sectors. So some summaries on the broader markets. Since the beginning of the year, the NASDAQ is off as of today about 28%, the S&P 17%, and the Dow 12%. And on the private side, both the number of deals and the amount of capital being deployed over the past quarter and a half is down considerably since 4Q. So Q1 was down. I'm not sure what these percentages are, but it looks like Q2 will be down about a third from Q4. So how is this affecting valuations? Before we get into that, also interesting on the public side, another indicator, IPOs. This is European data. I haven't been able to get US data for IPOs, but from 2021 IPOs alone, values are down over 50%. So the things are hitting the fan, and something that most people are, commonly refer to. They're interested in knowing what are the revenue multiples for public and private companies looking like right now. How they've been affected. A few years ago, 10x became almost a new normal, at least common belief, even though it wasn't really true based on, or supportable based on data for smaller companies. But nonetheless, everybody thought that their SaaS software company was deserving of a 10x revenue multiple. And after, in the fourth quarter, I started seeing data supporting 20x even was not too uncommon anymore. But this is the absolute best data I've seen breaking down SaaS or software revenue multiples by sector over the last year. And we see that even by subsector, fintech itself was getting about 25x revenue in October. And that's when things started to snap. And all of a sudden, whether it's fintech, enterprise tech, consumer internet, etc., we're down. Everything's sub 10x, basically between about 3 and 7x. So off well over 50%, up to 80%. So that's a little surprising, even to myself, when my gut was telling me things were down about 30% since the beginning of the year. So, and that may be true since the beginning of the year itself, but it actually started back in October. So, given the lag between deals in the private sector that are getting done, the prices are being set a few months ago. By the time they come around and close and we get the data, we don't ever really have current data. So we have to expect that companies that are going out and trying to raise money would be well served to manage their expectations about their asks. I've seen some of my clients reduce their valuations in half over the past few months to in mid-round trying to close their rounds out. So it's pretty challenging out there right now. And without this kind of information, it might be a struggle for many companies to close out their rounds. So that said, how we advise them, I'm sure some of the graphics aren't showing up here. In terms of how we walk our clients through the early stage valuation process, traditional evaluation methods don't apply, discounted cash flows, income approaches, and so on. And without positive cash flow, we'll revert to the revenue multiples, which is a more common metric that we just discussed. But without even material revenue, we have another one that I've developed out of some academic white papers out there and sort of put into a model of my own called the scorecard method. And it tries to objectify or use as much data as possible to in a very subjective to apply to a very subjective question. So the scorecard method applies a weighted average methodology to score a company based on its management team and experience, the size of the market of the company, the product's strength and IP, its competition, marketing and sales partner, how much have they developed their sales channels, and their funding status, and then some other, whatever miscellaneous other factors we might add in at the end. So it all ends up yielding a factor or a variable of plus or minus one, one being par. And we're going to walk through this in a practical way, in a real life way, with a friend and good client, Monica Williams from Red Drop's CEO. Monica and I met through Ty's Access program not long ago. I guess it was September of last year or March of last year that we spring that we did the evaluation. And we've done a couple of evaluations for Monica for different reasons. We did one for her funding process, so she would be able to be comfortable going out and with the ask that she was making. And we'll talk about that, and also for her option pricing for her employees. So high level, when we start this scorecard method, we start with a national valuation based on the data that's published, which changes every year, but that's only the first level of many levels of peeling back the onion. Just taking a national median angel stage valuation isn't going to satisfactorily approximate what any particular company's valuation should be. So we've got to look at other factors, such as the region where we are raising money, the size within a sector. A pre-revenue company is different than an angel stage company that is already making a few $100,000 or $500,000 in revenue. And their sector, is it B2B, B2C, B2B2C, and what's going on in the market this year, not just relying on last quarter's or last year's data. So obviously we've talked about how that's huge right now, as well as the company specific factors that we assess, as I mentioned in the scorecard method. So overall, in this generic example, we can see how taking an angel stage B2B SaaS healthcare company with a first-time CEO as of today might end up with a value less than half of what it was in December when taking 10% discounts for the Southeast versus the national number that's biased by the tech hubs. The size being a pre-revenue company, getting another discount, a premium for the SaaS model, the year-to-date adjustment, roughly 50%. These are just kind of a swag, but and then the company factor itself. So what was $7.5 million at the end of the year might be about $3 million right now, and that's really key to be aware of when you're going to ask investors to think about writing a check right now. So that's let's bring Monica up and talk about what we did together.
Greg,
Hi.
how are you?
Thanks for joining.
Thanks for having me. Let's
So-
talk about periods, evaluations, we're gonna have a good time.
I'm going to let you talk about that. So tell us about Red Drop first of all.
Okay, so Red Drop was founded in 2019, started selling in December 2020, heart of the pandemic. And our core business is really tween periods. And so if you think, it's not a lot of women here, but if you have daughters or nieces, when you start your period, you are generally smaller than an adult. You have less flexibility. It's 67% of girls will start their period in school. So you have 2 bathroom breaks. You have a much more active lifestyle, and you need odor control without fragrance. So our products are specific to tweens, and we package them in a way that if bought before your daughter or child starts their period, it provides a centerpiece around which to have that conversation. And so, again, if you talk to almost any woman and you ask her, this isn't a common question, but if you ask her about her first period, a lot of women are transported right back to that moment. And I think we underestimate the impact and the power of that moment. So we really try to transition girls into that space in a really positive and prepared way.
As a dad, I don't recall it at all.
Shocking.
So when did you start the company?
We founded in 2019. We started selling December 2020.
Okay. And so when you came to me in mid 21, there were a couple 100,000.
And they were between 200,000 and 300,000. Yeah.
And where did you end up at the end of 21?
Well, I mean, supply chain. So we probably should have had about $1 million a year. We ended up about half of that. So it was a strong first year, but it was certainly stymied by factors out of our control.
Which speaks to the reason for declining valuations. Forecasts aren't being met, short term or long term, which means exits are extending and you need more capital to get where you want to go.
Amen.
Right. So, what were your questions or concerns when we started working together? What did you need from evaluation services consultant or coach?
So for us specifically, the way we were introduced to you was through TIE. We are in the TIE Access program and we placed. And so honestly, for us to receive our award, we were required to get evaluation. In terms of concerns, I would say this is my third company. I've never had a formal evaluation before, so I just didn't really know what to expect. So as a part of the TIE Access program, you have 2 mentors, and so they really stress being prepared because, especially with your scorecard method, a lot of it's about interview and just kind of getting to know me. So we met on that at that interview, and so in terms of concerns, I guess I just wasn't really familiar with the process. I didn't know what you'd ask. So I was just kind of anxious, I guess.
Seems pretty
A little
mysterious.
daunting, yes.
Right.
Yes,
Right. So that's my job to sort of demystify the evaluation process.
you did a good job of that.
And to your credit, your experience at this being your third startup, lent itself to a stronger than average score in that first and most heavily weighted component of the scorecard, on the management side. So that gave you a good start in the scoring process. So let's talk about, how we work to that. You've given your permission to look at your real data.
Sure.
And we'll talk about the two steps of the process. The first one being the macro level, and in these charts, how over the past 10 or more years, I've tracked the national angel and seed stage valuations from various sources, and you can see how they progress from about 2.5 million to was at the end of 20 when we worked together. 21 data wasn't available yet, but as I showed in the slide before, 21 angel data went from 3.5 to 7.4, more than double the angel stage median valuation in 21. But and now we're falling back. But at the end of 20, at 5, the first two adjustments we made to that were the 30% discount for the Southeast region, which, interesting to know, more recent data has suggested that that's narrowed, that we've become more competitive basically with the tech hubs, and we're seeing that number closer to 10% now than 30, which is encouraging for the Southeast founders. And being in a B2C sector, there was no adjustment. We didn't get the premium for the B2B type model. So we started with 3.5 before we got into your company specific assessment, and tried to sort of summarize this without getting into all the details of all the questions, just seeing the categories that we look at that I mentioned. You got over 100%, for par for your background, and as well as the size. We put a 2x score on obviously a huge marketplace. So
6,000 girls a day.
yeah. So the bigger question is, how will you attack that market and approach it, get into the competition, talk about, what you're facing and how you think about breaking into the market.
So it's interesting. We've learned a lot, actually, since we worked together. So we still our strongest channel is still B2C, but we have really expanded our B2B side of the business. So I think when we talked, I told you that we sell direct to consumers, but we also sell to schools. We've had 300% growth in that area and 100% retention of the districts we work with. And we're starting to build a pipeline of that business. And the reason that that's been really helpful for us is, like I mentioned, 67% of girls start their period in school, or will experience a first period in school. And so having our product as the one that they're introduced to first is great. And so the next step for us is actually retail, because once they get it in schools, now where can mom go to buy it? And so we've had a couple of really good meetings with some big box retailers. So for us, I think growth we've certainly grown in B2C, but I'd say that our B2B channel has probably grown more interestingly.
So what percentage of your revenue might that B2B channel represent at this point?
It's still not the majority, just because what we sell there is pretty small, but the impact for our business is much bigger.
Mm-hmm.
So I mean, to answer your question, it's still less than 20%.
Mm-hmm. But huge opportunity.
Big opportunity for us, yes.
Good to know. For your next valuation. And how about your distribution and marketing? How's that going through partners or the channels you created?
No, we still do mostly social media marketing. For the B2B channel, we're using relationships and a more direct, more traditional B2B sales approach. But no, marketing has not changed for us much, other than just trying to tweak marketing for the new iOS standards and privacy. So we certainly had to make some adjustments for that.
And how about on the competitive side, do you feel like you've started to get your brand recognized out there to challenge who are the bigger players that you're trying to break in?
So when you look at specifically teen feminine hygiene, there are two brands, You by Kotex and Always Teen, that sell products that are marketed to teens. But when you really break into the box, they're just size one pads that are in colorful packaging. So, I mean, you can't ever say you have no competition, but truthfully, if you're looking for a feminine hygiene product that's really made for tweens right now, there isn't competition. But in terms of brand recognition, because it's such a big space, I mean, we certainly have some, but there's a lot of room for opportunity, a lot of room for growth there.
How are you gonna get to the next level? Are you gonna crack the code?
Well, honestly, I think schools is one of the biggest ways we're going to do it. Schools don't have a lot of options. I mean, they go through school health and they can buy packs of pads. Unfortunately, packs of pads that you can buy through school health aren't even the teen size pads. So we have a lot of opportunity in that space, and that's really where we're trying to level up.
So how's the runway going, as they say? Are you gonna need to raise money again at some point, sooner or later?
We're trying not to. I mean, especially this is before I came to this presentation. So we are pretty bootstrapped, and we were before the Thai access opportunity, and we run a very lean operation. So yes, we probably will need to raise money if we make it into retail, because it's such an expensive proposition, but I'm trying not to raise any more than what we absolutely need.
Yeah, good idea at this point. So you don't have to experience any more dilution than necessary.
Right.
So after we came up with your company score, which was above par, and we ended up with something just over par at over the 3.5 at about 3.7 rounded. Before we get into so that was for funding purposes, and that before we get to that, you have to adjust for cash and debt to get to an equity value from what we call the enterprise value. And so that was my recommendation as you went out to raise money. So how did that go when you went out and threw that number out there?
I can't say the number wasn't challenged. Fundraising has been and continues to be challenging for us in general. So it's going, it's slow. It's not easy for us.
Over the years, my experience in Atlanta, attending many pitch events, whether it's through Ty's Angel Group or the Atlanta Technology Angels, there's just kind of a mindset. There's even as the data changes, a lot of the experienced, sophisticated investors just know what they're willing to do in a deal, and depending on all the factors, it's almost, even speaking to Sig Mosley, who's the sort of known as the godfather of angel investors in Atlanta. He doesn't have this like modeled out, but he does it all in his head, very, very quickly. He would articulate all these variables, and he just sort of intuitively processes the weighted average of these things and comes up with 3, 4, 5 million. But he knows that, and that he's just not willing to generally go over 5 million for an angel stage company. And in some ways, collectively, that's a little bit of a constraint for Atlanta companies as the market was exceeding those values. They weren't showing up here. People weren't really buying it in Atlanta. It was much easier to achieve out west or in Austin, Texas, or New York, but thus the disparity in the valuations from region to region. But so something in the 3.5, range is very palatable for this investment community, and so I'm glad to hear you didn't have any issues with that. So from there, that being the first reason Monica needed evaluation, then we took the next step to do your IRS 409A option pricing calculation, which then starts with that number and gets allocated throughout the cap table, depending on how many classes of shares are in the cap table, and to determine the value per common / option share, which, just as information, many people may know that it's not just a straight division number. You don't just divide the numerator, the company's value, by the denominator, the number of shares. When there's one share class, you also get discounts for lack of control and marketability. So this is a very basic example of what we do to apply those discounts, which in this case were 10% for the lack of control and 50% for such an early stage company for lack of marketability. So you go from what's known as a controlling marketable value on the 100% level to a minority non-marketable ownership interest basis value for the per share value, in this case, $1.39. So that's what she is able to use as a floor for the option price to issue to her employees. She's free to issue it above that. The IRS doesn't mind if you're more conservative, but they get upset if you issue cheap stock below fair market value, which they will assess penalties on to the company and the employees if they ever determine that you stepped below fair market value. And so what you achieve, or the company achieves, by getting the 409A done is called the safe harbor provision, which is like an insurance policy to excuse them from any potential penalties at any point. These have to get done every year for any company issuing options. And more often, if there's a material event, as they call it, which is most often a new round of funding, or maybe a huge new client letting the Chick-fil-A coffee deal or something like that. So it's about time for your next one. So that's how we helped you. How many optional, how many employees do you have right now that receive options?
Just one. We use this just for one person.
Mm-hmm. What are your next hires going to be?
Honestly, at this point, we are trying to outsource as much as we can until we really find the right person. Honestly, I struggle sometimes with finding a really good fit. So we really try to outsource the positions or the roles or those responsibilities until we find the right fit and then hire. So in terms of things that we're looking for, we're always looking for more marketing, e-commerce, almost 100% marketing, and some R&D.
I would say I get a lot of questions from clients asking me, what can I do to increase my valuation? And my answer is always sell something. Keep selling, sell more. The more revenue you drive, your valuation increases exponentially. One of the biggest sort of things we look at and that we see in terms of the data when we list public companies and private company M&A deals by size is the correlation between size and market multiples. So as companies grow, those multiples expand. And this is sort of where the 10x revenue multiple myth or notion came from. It's out there, but the question is at what size do you start to see that? And it moves with the market, but generally it's around $2 billion in revenue when you start to see public companies display or demonstrate a 10x multiple. So even between 100 million and 2 billion, revenues were running between 4 and 7x, and under 100 million, which is still larger than most of the clients, Series A and B and Angel, especially C and Angel. It's just not true. You know, when we look at M&A deals for smaller companies, less than 50 million that just aren't public, they're all private. And typically it's 1 or 2x is all that they get when they sell. So there's this big disconnect between funding valuations and transaction valuations. And it makes it really hard to make money for an investor. If you're pouring money in at these huge multiples and then you can't realize them either when the company sells when they're small or go public and the valuations drop. So it's a cautionary tale about, chasing private company investments. It makes it hard. Questions?
Sure. I'm sorry for being late.
Sure.
Preaching surgery.
Oh,
Sure.
okay.
So if I can interpret what you just described, firms that don't anticipate ever growing larger than 1 or 200 million are significantly disadvantaged within the investment community. Is that fair?
Just in terms of their expectations to possibly
To
sell.
attract investors based on the multiples, 1 to 2. A multiple of 1 to 2 just seems to be lackluster for a lot of investors.
So again, due to the supply of capital, which you may have missed it at the beginning, we were talking about how where this excess supply of capital comes from, often pension funds that are competing to deploy their capital and bidding up valuations. So still, even in this market, while valuations are down, a SaaS company with 2 million to 3 million revenue today, during a conversation said, we were doing a 409A, in which option prices are considered on a more of a fair market value basis than a strategic or investment value. It's like, I understand this is for option pricing, but what do you think about me going out and raising money at a $15 million valuation right now with 2 to 3 million? And I said, it's not, you might have gotten 10 or 20x last year, but it's not crazy to still think that, to go out and ask for 7x. You pass the sort of magic $1 million revenue threshold where valuations start to increase and multiply. So no harm in asking, but that said, it's still a challenge not to experience maybe a down round later or to exit for a number that your investors or you might find satisfying. Later, you just might be disappointed that sales multiples, transaction multiples aren't living up to the funding valuation because of that pressure for the firm, funds, VCs to deploy, participate in the market. So.
We ready for questions?
Yeah, sure.
Yeah.
Good segue.
Anybody else have questions in the room?
Yeah.
Sebastian,
Oh.
Quentin, you have a question?
Yeah.
And the mic. You have to go online. They can't hear you without the
Probably
mic.
can't hear it. Okay. They probably don't want to do this. Okay. We haven't had, this looks like the beginning of correction to me, okay? We haven't seen this in a long time. I've got some gray hair under here, so I've seen it in the past. So these things can tend to go to overcorrection.
That's the nature of the game.
The nature of the game.
On both sides.
So if I'm I'm an entrepreneur and I can survive this, it would seem to me that in several months, whatever that is, 3 to 9 months, this thing is going to be overdone. Because if I'm a pension fund and I was doing 3%, now I'm at 15%, and looking at what treasuries are doing, looking at that return, it just seems to me it's going to get really overdone. And it may be more advantageous for those entrepreneurs just to be.
You're talking about the investor entrepreneurs or the
I'm
founders?
talking about the founders themselves.
Sure. Yeah, the obvious prescription right now is to conserve capital and try to grow and weather the storm and manage, costs. So you don't have to raise, dilute yourself and sell too much of the company at a lower valuation. You ultimately always trying not to sell a total of more than half of the company to maintain control. Otherwise, what's the point? So, yes, it's a tough time to be raising money, and especially in the middle of a round when you maybe got half or so of the money in at a bigger number and you're just kind of stuck in getting the rest. So you've got to make a decision. Are you going to cut the valuation for everybody? You're not going to, harm the ones that put in it more and get, start selling it for less. So you've got to, discount the entire round, and then where are you going to go from there? It's a tough call. Maybe just take what you've gotten and cut it off. Just try to work with that.
Do we have any questions online?
Anything online?
Okay, they can hear you. Go ahead. Fashion.
Rahu, ventures at what level? A, B, C, everything. Revenue multiples based off smaller companies. What smaller media companies, which are typically 12 to 20x? Hey, if you want, you can say your question. I can unmute you.
Hey, Greg, we're going back several slides to one of the earlier slides in the presentation. I think they were the gray ones, maybe the second or third gray one.
1 second, she's pulling
Just
back
a
up.
second. Go ahead and ask your question if you want to.
Sorry for creating technical difficulties.
Go ahead. Is that Raul?
Yeah,
I hear your voice, Raul.
Is it that obvious?
Okay.
How are you guys?
How far back?
I think it was back another 2 or 3 slides. Might have been the one after that.
What's the topic?
So in regards to venture, at what levels are dropping, are they the A's, B's, and C level, like Series A, B, C's, or is it across the board? And does it vary between the level of funding? And then as far as the revenue multiples go, are these drops predominantly for smaller sized companies compared to larger sized series investments? And what about, is this specifically for fintech, or are we, because that seems to be a common trend these days. Everybody's so focused on fintech. What about media companies? Because they typically have 12 to 20x multiples. And I was wondering how those fit in within the previous, sorry, that is the slide, thank you, within the chart.
So a multi-part question. Whenever I've asked any more than a one-part question, I've never gotten the answer to the second part. And I think there were 3 there.
That's fair.
So let me see if I can remember 3 things. I can never remember more than 3 when I go to the grocery store without this. I have seen some general commentary about, but not any specific data about stage valuations by stage. I've read that the later stage companies are getting hit harder because they've had even higher valuations. They were more attractive to the VCs as they demonstrated progress. So they had higher multiples, which are now being whacked back more dramatically. So I would say progressively, less reduction as companies get smaller, at least relatively. by sector, I don't have any media specific data here. We've got fintech, consumer internet, enterprise, sort of the FAMG, which is I guess Facebook, Apple, Amazon, Microsoft, and Google, the large cap, which seems to have been affected less than the rest, despite Amazon getting hit really hard. So I would, as far as media companies being 12 to 20x revenue, I'd like to see the data on that. Maybe that was back in the fall, but I would suspect that it's been more, they're more now in line with what we're seeing here between, 3 to 7-ish, depending on their size. So that was 2 of them. I think I missed the third.
I think you covered pretty much what I wanted you to cover. So thank you so much, Greg.
No problem.
What other questions do we have, Sebastian?
JP put in, even though equity markets are down, there's still a lot of dry powder on venture and PE funds balance sheets that need to be deployed. Any thoughts how that affects valuations or general thoughts?
I guess that's the existential question, JP. I mean, what to do with the big pile of money in the bank? I'd be sitting on more cash than I've ever sat on right now. But I'm under no pressure as a solo investor to deploy that. If somebody was expecting, with my job on the line to have to turn it into something, I don't know where I'd go with it right now. I mean, hedge funds have been going to real estate to for lack of a better alternative right now. And I moved to Florida, at least for tax purposes, 6 months and a day in January. And, the prices have gone through the roof in Florida and other states with no state income tax. But that anecdotally is starting to revert and maybe soften a little bit. So if the real estate market starts to drop, then where do people go? I mean, the ones that will invest are going to obviously provide some support to the market and valuations, but there are going to be others that find, I don't know, are they able to sit it out? I mean, if so, for how long? We've got the election coming up in November. I think a lot of people are debating if and when the bottom might be here at some point ahead of that election. So is that August, September? It feels like many people I talk to, and I talk to people about it every day, trying to call the bottom, feel like we're not there yet. And some feel like the election will at least create a floor and start to move things in another direction. And I talked to somebody yesterday who used the D word, and as he called it, and calling for a depression. So who knows? We're all trying to forecast, like weather people. You never call the bottom exactly, but a smart thing to do as at least an investor in public markets, I mean, being down 30-50% is to dollar cost average. I mean, if you want to, you won't call the bottom exactly, but at least there's a lot. It seems like there's a lot to be made on the upside if you just trickle money into the market over the next 6 months. For what it's worth, for my 2 cents. But yeah, hope that answered.
These are great questions.
Yeah,
Do we have some more, Sebastian?
No, not right now.
Our hybrid audience. Okay, do you guys have some questions? Here. Delma, right?
Yes,
Delma, I got you right? Okay, perfect. So Delma is new to us here at TIE. So first time.
Hi, everyone. Okay, so I have a question. I am an inventor for assisted daily living device. And I've been told with the idea of either trying to create a company or a licensing deal around the idea. So if I were to go for a licensing deal or agreement or what have you, would evaluation still be necessary for projections for the sale of my device future, or, you know what I'm saying, in terms of trying to get a license degree, would evaluation be necessary, is what I'm asking, in order for me to make it appeal to whoever I'm trying to sell it to, or whatever other choices there would I would have to do, is what I'm asking.
So if I can sort of rephrase that into, do investors prefer having an independent valuation when making an investment decision on a pre-revenue?
There you go.
Yeah.
Yes.
It never hurts, and it usually helps to both the founder and the investor have some confidence in there being an assessment, and it gives you the confidence to present something and not look like a deer in the headlights, or just say whatever you think, or what's your offer, I'm flexible. It comes across as a little unprepared, in my opinion. I've moderated panels where I think Sig Mosley was on the panel, as well as a sophisticated investor named Bob Kramer, and good friend, and they disagree about that. You know, I think it was Bob that prefers, and there be one, and Sig just doesn't really care because he knows what he's going to do anyway. But again, I think it helps you to feel more comfortable when negotiating, to understand the key points and why, if somebody's not being reasonable, you know, not to be taken advantage of.
Absolutely. See that. Thank you so much.
I'm sure this is a fairly easy question to answer. Of all the macroeconomic factors, international and domestic, that are happening right now, which do you think would have the greatest impact on turning this curve around?
It seems like everybody's most concerned with inflation. If there's just not enough, not as much capital to be invested and deployed, if it's being siphoned by bills being paid. So talked about the supply and demand of capital and how that drives valuation. So if more capital's available with less inflation, I would think that's the big one.
Thank you.
Would that be your guess as well?
Well, there's so many heavyweight things happening politically, as well as the global economy. Certainty driven by conflicts. Or Ukraine sudden to come to an end having that happen. Either party wins or some Supreme Court justice or some Supreme Court decision goes another way. It's just you would think that might have a big lever over how the stability of the market is seen in its prospects.
So in my mind, the supply chain issues are probably second, and even Monica mentioned that it's affected your ability to produce your product. How did it? In what way? What were you not able to get and why?
Well, it's not louder. We work with 9 factories, all of them are in China. So it impacted the entire business. So if we couldn't get inventory, we couldn't sell inventory, we couldn't create revenue.
Are they doing the manufacturing? I mean, where do the raw materials, they come from China as well? Interesting. So even down to the baby formulas or whatever, if you can't make product, you're not selling anything, you don't have revenue, you have no ability to create value. I on the side, as a passion project, I've spent several years writing a book that I'm hoping to get to market before football season because it's a football history. On the pre-NFL era. And that's a big thing for me to be able to deliver it before football season and have a launch party, at the College Football Hall of Fame, in early September. So if the book's going to be printed in Korea, South Korea, so they estimate that they can get it to me in August. I mean, am I going to get it or not? That's going to make or break my ability to have a big, launch in the fall. So it affects every sector differently, and but it seems like it affects almost every sector. Gotta get my book plug in there.
That was like, right, yeah, I caught that for sure. Anybody have any additional questions? Online, Sebastian, how are we
We're
doing?
good.
Everybody's good?
All right, we're right on time.
Okay, perfect.
Thank
timing.
you, Ty. Thank you so much, Monica.
Great, thank you so much for being here. We appreciate it. I absolutely love the workshops because it's just intimate. People can ask you questions. You're always awesome. Thank you so much. Before you leave
You
the
too,
stage, thank you. Tell everybody where they can find you, Greg. Obviously, Integgra was all over the screen, but how can they get in touch with you if they're interested in working with you, just like Ms. Monica did?
Integra.com. Integra has 2 G's, which my first name ends in 2 G's. Greg with 2 G's at integra.com is my email. So feel free to reach out and love to work with you.
Awesome. Thank you so much, Greg. And I'll include his information in the follow-up email.